Yesterday we talked about Jasmin, and Jasmin had a problem. Her problem was that she earned all her money at the beginning of the year, and by the time she got to the end of the year, she had absolutely no money. So every year she found herself in a situation where she had absolutely nothing by the end of the year. That was really, really tough for Jasmin, as being poor is never a good option. So as business owners, many of us have had similar situations. Maybe not exactly the same as Jasmin, but that issue that what we essentially have is our variable cash flow. So there are times when we make a lot and at times when we don't make so much. And then we make a lot and we don't make so much. We make a lot maybe for a while and then we don't make so much. Often our income is that way. Maybe it slants up the whole time. Maybe it goes sideways. Hopefully it doesn't go down. But in some way, most of us are going to have variable income. And the problem with our variable income is usually we have our fixed costs, right? So our income is variable and our costs are fixed. So at some point, if we're in a situation where we haven't made income for a while, our costs are going to eat up any capital that we've got and we're going to be poor. So that is the problem. So Jasmin was saving her money in cash, and saving would be in quotations at this point. She wasn't really saving at all, Jasmin, but we saw the issue with cash was that it is too accessible. We've got our debit card and we can take cash out all we want. So that's a real problem with cash. It's just too accessible, too easy. We can just spend it all and it's gone. Very easy to get rid of. Jasmin, again, thought about private equity. Well, what about private equity? I could use that. And the problem with private equity, of course, is that it's illiquid. So we have no access to our private equity, right? And we can't borrow against it. We can't do anything. We're stuck. We put the money in and then we need it at this point. There's no way we're getting that money, or no way that we're going to get that money in any kind of reasonable fashion without selling it at pennies on the dollar, right? So we were looking for that Goldilocks investment. So now let's consider some different investments that we might use to hold on to that money. So we've got a store of value, because that's all money really is. That's all assets really are, is a place to store that value that we've created in the world. So we're going to store that value and it's going to be Goldilocks. We've got the access we need without too much access to it. So what about stocks? How are they as an option? And I actually have fallen prey to using stocks as an option, as a store of value in the past before I knew better. And I know how stressful it can be, and this is why it's stressful. So what's great about stocks? Oh, they're pretty liquid. In fact, they're completely liquid. Maybe not completely liquid as cash is. We can't usually use a debit card on our stock portfolio, but it's probably only going to take a couple days to get access to this money, a day or two. So they're very, very liquid, almost as liquid as cash. So, hey, that should be great. So we've got the liquidity, check. It's not quite as liquid as cash, check. Maybe that's the Goldilocks investment that we're looking for, that we can store our capital with. This is where it gets a little bit more complicated. Stocks are what we call volatile. And what volatile means is that they go up and down and up and down. And hopefully the long-term trend is that they're going up, but they don't get there in a straight line. They go up and down and up and down and up and down. So if we're in a situation where we need cash now, and we need cash now, and we need cash now, and we need cash now, that was amazing. We ended up buying potentially at the low and selling at the high. Buying at the low, selling at the high. Buying at the low, selling at the high. Maybe we're only cashing out our profits. We retain our capital. Everything's amazing. But, and I've been in this situation and I've had these kind of white knuckles. This is the issue. We don't know because our income is variable. We don't know that our need for money, our need for capital, is going to fall at the peak of the stock market at each time. It may fall at the trough. So we may be in a situation where this is where we need the income. And we're forced to sell. And we're forced to sell at the bottom. I would even say that when the stock market is doing poorly, that may mean that businesses are not doing that well. And it's a more likely correlation that you're going to need the money at the bottom of the market instead of the top of the market. So we have to sell here. Maybe we have to sell here, sell. And we end up running out of money pretty quickly if we're always selling on the bottom. So that is the issue. It's a timing issue. It's got some liquidity, check. It's got somewhat reduced liquidity, especially if you don't want to sell at the bottom and you're going to wait until the stock gets back up here again. But there's a timing issue in that we might not be able to wait. We might be forced to sell at this point. So how do we generally manage a timing issue? Generally, we manage a timing issue with debt. So ideally what we would do is say we were in that, we would get debt up front. That's what we would do. Say we were in that situation that we were fine here, we had all the income we needed, and then we came down here and we need the income right away. Now we've got a choice. We've got two different areas that we can go to get that money. Number one, we could sell. That's an option. Number two, we could go to our debt and get the money here. And that's how we solve that timing issue. We can use this as a surrogate or a substitute for this. And then when the market returns back up to the top, we can recover that debt and move along our merry way. We still managed to sell at the top because the debt solved our timing issue of having to sell at the bottom. So it looks great. It looks like we've solved our problem with using debt in conjunction with our assets. We've managed to solve the problem that we may be forced to sell at the bottom. But this is where it gets a little more complicated. This is a very simplistic view of how the stock market goes. If we all knew for certain that as soon as it dropped a certain amount, it's going to return back up, then we could time our withdrawals from debt and our deposits back into debt very easily. We could schedule it for every up end of the market and every down end of the market. But markets are unpredictable, and that is our problem. We've got two variables that are unpredictable. Number one, Number one, our cash flow. We don't necessarily know exactly when we're going to be in a position where we don't have cash flow. Again, Jasmin knew with some certainty that she wouldn't have any money at the end of the year. But who knows, maybe one year she didn't have any money at the beginning of the year. That is a possibility. And number two, the unknown variable is where the market is going to be at any one time. So we're dealing with two unknown variables. So this is how unknown the whole thing might be. So we might buy our stock here and it might go down. And here, oh, we've got a cash flow issue. I'm going to have to sell. Oh, well, what can I do? I can use my debt to cover me because I don't want to sell while it's low. But what you didn't realize is that it actually wasn't low at that point because it was going to continue falling. So now we have to sell again. So now we're absolutely certain, oh, we're at the bottom. It's dropped so much. We are going to use our debt and we're going to wait for it to return back up and then we can cancel out our debt. Problem is, markets can still go down again. So while we're expecting this pattern could actually be this pattern. We don't know exactly how it's going to play out. So in this case, we took on debt once, we took on debt twice. Now we're really stretched. We come to a situation where we don't have cash flow again. So we want to take out debt a third time, but there's no debt available anymore. So we have to sell out. And maybe even selling out these assets is not going to be enough to cover our debt. So we end up in bankruptcy. So that is the long-term worry with a strategy like this, that we're going to build up so much debt and we can't pay it back that we're going to end up bankrupt. So that's why we don't want to use something like debt and stocks together, although they really are a nice combination. The problem is with having these two unpredictable variables together and adding in the debt, we make this situation really, really dangerous. Debt is a tool. And as we've all heard, a tool can be used as a weapon. And as we all know, that weapon can be turned back upon us. So what essentially happened in this case is we were using the debt for our own advantage, but that debt ended up being used back on us to harm us. So we've looked at a few different options. We know that cash doesn't work because it's too liquid. We've looked at private equity. You know that doesn't work because it's too illiquid and we can't use debt. We know that stocks don't work because they are too variable. So those are three options, at least on their own, that aren't going to work for us. So what we're going to have to do is look at some different options or some different combinations of options that will help solve our problem. We'll talk to you tomorrow.